Okay, hello and welcome to another tutorial video. This time we're going to be going over the leveraged buyout model again, and specifically focusing on the sources and uses schedule. And just to give you an idea of what we're talking about here, I'm going to bring up examples from a few different LBO models in our courses, where we have the sources and uses schedule. Here's an example for the $3 billion leveraged buyout of J.Crew. And then we have another example here for a hypothetical leverage buyout of Best Buy. And we also have similar looking sources and uses schedule there. And then a third example is for the Dell leverage buyout, Silver Lake's $24 billion leverage buyout of Dell. We again have a sources and uses schedule right here. So it's a very common feature in LBO models and something that you're going to need to understand if you want to really understand the leverage buyout model in depth. And the reason why it matters so much is that your sources, your funding for the deal, has to equal your uses, how you're spending the money. It's sort of like how the asset side of a balance sheet has to equal the liabilities and equity side, or like in math, how two sides of an equation must balance, or in physics, how energy and momentum can be neither created nor destroyed. So if you've studied physics before, of course, you know about the conservation of momentum, the conservation of energy, and basically it says that with any change that you have in the natural environment between objects moving together, something like that, energy is going to stay the same. You cannot create energy, and same with momentum, mass times velocity. It can't be created, it can't be destroyed. So it always has to remain in balance regardless of what goes on outside. And it's sort of the same thing with the sources and uses schedule. Money, in this case, we're not talking about energy or momentum or math, but money can be neither created nor destroyed. Now, as I say here, sort of tongue in cheek, yes, central banks, of course, have been known to print money irresponsibly, rampantly, to devalue currency. So that is one exception. But companies and private equity firms can neither create nor destroy money. And that's what we're dealing with here. So that's why it matters. And to illustrate these points going through this, what I have up here is extracts from some of those models that I just showed you. A simplified sources and uses schedule for J.Crew, and then a more complex one for Best Buy, and then an even more complex one for the leverage buyout of Dell. And so what we're going to do here is, once we go through a few more points and what to watch out for on why sources and uses matter, I'm going to tell you what goes into the schedule, how you build the sources and uses schedule, a few more complex items, and then we'll go through at the end what to do next if you want additional practice with this topic. So as I say up here, the point that the sources and uses schedule, the sources must balance the uses, that's all well and good. But the real point of the sources and uses schedule is that it determines how much cash the private equity firm has to contribute toward a deal. And that in turn determines the internal rate of return on the deal. So if the PE firm puts in less cash, well, it's easier to get a high return. If the PE firm puts in more cash, it's more difficult to get a high return. So they could sell the company for the same amount, but if they paid less for it up front, they're going to get a higher return. If they paid more for it up front, they're going to get a lower return. So that's why it's so important. We're saying, okay, here's how much it costs to buy this company with all the expenses included. Here's how much debt we have to fund it. Here's how much in other sources of funding we have. And then you say, but taking into account all of that, we still need to put in something ourselves to close the gap, to make sure, for example, that when we buy a company and we have to pay $3 billion for the equity and we have, say, $1.6 billion of debt, well, we need to plug that gap somehow, and the way you do that is with investor equity. So this is the real point of a sources and uses schedule. Yes, both sides have to balance, but it's really all about calculating this number, figuring out the private equity firm's own contribution. And then one final point here is that this schedule often explains why shareholders dislike buyouts and how and why they can often get a bad deal from these types of leverage buyout transactions. And we'll go through an example of that toward the end with, again, the Dell deal, using that as an example. So step 2 here, we've been over why the sources and uses schedule matters and why it's so important for a leverage buyout model and the real point of it. Step 2, we want to go into what goes into a sources and uses schedule and how do you build one. And I think it's easiest here to start with the uses side. So in other words, what you have to spend money on when you buy a company. And there are basically 3 main categories here. Number 1 is the equity purchase price of the company. So you have to buy all the company's outstanding shares to acquire a company, or if it's private, you just pay a lump sum for the company. And then you also have to pay fees to a lot of people. Bankers, lawyers, lenders, a lot of others advising you on the deal or providing financing, so there are fees. And then a third major category here is if debt gets repaid. So if the company already has existing debt, if that gets repaid, this also counts as a use. Why does it count as a use? Because if you're spending money to pay off that debt, you need to put in more of your own cash, or you need to raise more debt to pay it off. So those are the three main categories here. Now let's go down and take a look at the uses schedule for J.Crew, using this as an example. So the equity purchase price here was around $3 billion. Then we have around $25 million of fees. And then the third major category, they had about $24 million of debt, so we're assuming it gets repaid. So we can add up our uses of funds down here. And really, those are the main categories. Even in more complex schedules, they're usually just variations of these and different categories within these. Now, let's move to the sources side next. Now, the main items here, as I say, are the debt that you raised to buy the company and then the investor equity. So all types of debt, you can have one tranche of debt or 2 or 10 or 15, and then the investor equity, what you have to put in personally to fund the deal. There are all different types of debt here. You have term loans, you could have a revolver, you can have senior notes, subordinated notes, mezzanine. I'm not going to get into the details of these because it's not what this tutorial is about, but I've arranged these in order of roughly the least risky to the riskiest form of debt. And then the important part here is that when you calculate the investor equity, the final category, you have to take your total uses and then subtract the total sources so far, so everything above the investor equity line item, and you have to follow this process that I outline here. So you have to calculate the purchase price of the company, add in the fees and the debt that's being paid off. On the sources side, add the debt that you're using to fund the deal and any other sources of funding. And then when you calculate investor equity, you have to set it equal to total uses minus sources so far, and then add up total sources at the bottom. So let's see an example of this in action for J.Crew again. Now we've already added up our uses of funds here. We know it costs about just over $3 billion to buy this company and about $24 million to repay their debt. Now the sources of funds, so we've calculated elsewhere the amount of debt that we're using, about $1 billion of term loans, and then about $600 million of a riskier, higher interest subordinated note. Now, what do we do next? Well, next step here is for the investor equity, we want to take our total uses and then subtract our sources so far. So this plugs the gap. The investor equity here is always going to plug the gap, and that's why it's so important. And that tells us that the PE firm has to contribute about $1.4 to $1.5 billion of its own cash to do this deal. How is this important? Why does this really matter? Well, take a look at a few things here. We could look at this and say, okay, what if the purchase price went up? What if it went up to $3.5 billion? Well, now the PE firm has to contribute $1.9 billion. What if we funded it with, say, $1 billion of term loan A instead? Well, now the PE firm only has to contribute $900 million or $1 billion of its own money. So it directly impacts how much cash they're putting in, and it's going to very directly impact the private equity firm's returns on this deal as well. And that's why this schedule is so important. So we're done with this second part of this second step here, what goes into the schedule and how do you build the sources and uses schedule. And now let's go to the second half of this, which is a few more complex items that go into the sources and uses schedule. And I'm going to start with the uses side because that's a little bit more straightforward. Really the main addition here, the other addition that you could see is a line item called assume existing debt. And how this works is that if the company already has debt on its balance sheet, and as an example, let me just show you the model for Best Buy over here so you can see exactly what I mean. I'm going to go down to their balance sheet, and you can see here they actually already have an existing drawn revolver, and not only that, they have about $1.9 billion worth of existing long-term debt right here. So they already have these forms of debt. And the question in any buyout deal like this is, what do you do with it? Do you have to repay it? Can you keep it on the company's balance sheet? Now, obviously, most of the time, it helps the PE firm if they can keep the debt around because it means they don't have to pay anything to repay it. So it's usually in their interest to do it, but they cannot always do that. Let's take a look at the uses side for Best Buy just to see what happens here. So equity value about $8.5 billion for this deal. Assume existing debt. Take a look at this. We're assuming it stays on the balance sheet, so it appears under both uses and under sources, and it has no net impact on the cash that is required to do this deal. And that's the key takeaway here. When you're assuming existing debt, you're not paying it off, it appears under both sides of sources and uses, and it has no impact on the cash required. Now, under this, we still have some of the similar items, such as fees here. We have the equity value of the company. So those are all the same. We have refinancing existing debt, but this is the new item I wanted to show you quickly. Let's add up the total uses here so I can show you what happens in this case. We have about $10.5 billion. And then under sources of funds, so we have debt here on top, and it's a little bit different, but it's still basically the same thing, just different types of debt. We're using a few more different types in this case. We have assuming existing debt. I just went over that item. And then we have two new interesting items here, excess cash used and founder rollover. what does this mean? Excess cash used. If a company has a large cash balance that is far above what it needs to operate, it can actually use some of that cash to fund the deal itself. So instead of the PE firm actually putting its own cash forward or raising debt to fund the deal, the company itself can take some of that cash and say, you know what? We're going to use this cash to buy some of our own shares and help get this deal done. And once we do that, the PE firm will not have to buy as many shares, which is why it counts as a source of funds, because it reduces the amount of shares that the private equity firm has to pay, thereby reducing the purchase price and the cash they contribute. So that's one new item. Now, this item can be very controversial. Many shareholders really dislike this because they look at this and say, well, okay, you can do that, but what about if you just issue us a dividend and then we keep holding your shares? Because then we can capture upside if your share price goes up and we get a dividend. Why are you favoring the new investors in your company, the new PE firm that's going to buy you guys out? So this can be a controversial item. And then this other item here, founder rollover. So in this case, the founder of Best Buy owned 20% of the company. And in this scenario, if you have a founder or a management team that is keeping a certain percent of the company, what's going to happen is that it counts as a source of funds. Why? Because if they're keeping 20%, the private equity firm only needs to acquire 80% of the company, not 100%, thereby reducing the investor equity that's required to do the deal. So these are both funding sources because, again, it reduces the amount that the private equity firm has to pay. And that's a simple check you can do for any of these items. If it increases how much they have to pay, like repaying debt, that's going to go on the uses side. If it decreases the amount, then it's going to go on the sources side. And if it has no net impact, it's going to appear on both sides, like assume existing debt right here. So I have the explanation in words over here. So sources side, assume debt, excess cash use, founder or management rollover, and we've already been over all that. So what I want to do now is just flesh out the schedule and show you exactly what happens for this Best Buy scenario. So investor equity, we've already completed the first few steps of our process. We've added up our uses of funds over here. Investor equity, let's take our total uses and then subtract our sources so far. And then add up everything there at the bottom. So 10.5 billion and these match, and we've done this correctly. And then let's go down to this last schedule here for Dell. And I just want to show you this very quickly because there is one new item here that's interesting. Uses of funds. We still have the equity purchase price. We still have repaying existing debt. We still have assuming existing debt if we want to do that. And this, again, appears on both sides of the sources and uses schedule as it should. And then, of course, we still have all of our fees here at the bottom. So the uses side is pretty standard. Not too much there that's different. Let's add that up. The deal price here was announced as 24 billion because the equity purchase price at the share price that Silver Lake offered was corresponded to a value in about that range. Now, under sources of funds, we still have basically all different types of debt here at the top. The revolver here is not drawn in the beginning, so this is zero. So if you're not drawing on that revolver initially, this is going to be zero. The rest of these are drawn initially, so these all have dollar amounts. Assuming existing debt, excess cash we've been over, and then founder rollover equity, we went over that for Best Buy. And then the one new item here is the cash contribution for equity. So what does this item mean? This item means that Michael Dell, in this case, the founder of the company, said, you know what? I own a certain percent right now. I'm going to keep that stake. I'm going to maintain this and roll it over. But in addition to that, I actually want to put in some of my cash and acquire more of this company for myself. So you can actually change the ownership percentage in a deal like this. And that's another very important use case for sources and uses. It is a more advanced item, but it does come up and it's important to go over. What's the net impact of this? Well, if he puts in 750 million more, think about it this way. The new ownership is going to consist of him, these two items, and then Silver Lake. Now, these other items up here, these do not factor into the ownership because these are all other people's money. Raising debt doesn't give the lenders any ownership of the company's equity, so this has no impact. All that has an impact is these last three items here. And so what does it do? Well, let's take a look at it for ourselves. Investor equity, let's take our total uses and then subtract our sources so far. So 1.2 billion for Silver Lake. Let's add up our total sources down here. What is the overall impact of this? Well, the overall impact is that Michael Dell will now own, let's just do the math right here, about 78% of the company. Now, if he didn't put in that cash contribution, he would only own about 65% of the company. Silver Lake would have to contribute a lot more, and that is the impact of a cash contribution to up a management team or founder's stake in a business like this. So that's sources and uses. And as I say here, this is something that can really infuriate shareholders. And actually, I'm going to bring up the Dell LBO model to show you what happens. Take a look at this. Michael Dell owned 15% before, but then after the deal takes place, He owns 78% of the company. Can you imagine how mad shareholders would get at this? Because he didn't really do a great job of leading it. Yes, he owned a percentage of it, but the share price had fallen a lot, the company wasn't doing well. And then because of this deal, he ups his ownership percentage astronomically, going from 15% to 78%. And this is why people like Carl Icahn, for example, protested so much when the deal took place. And of course, the moral of this story is that if you understand the sources and uses schedule, and you understand that the equity here represents ownership in the company's new equity, and that everything else above it does not, then you understand how this works and the dynamics of why these deals can often be a bad deal for shareholders. So that's it for our tutorial. To sum up what we did here, we started off with why sources and uses schedule, that schedule matters, what goes into it, and how you build one. Start with the uses side, calculate everything there, then go to the sources side, look at debt. Investor equity is the plug, just equal to total uses minus sources so far. And then we looked at a few more complex items like the assumption of debt, excess cash, rollovers, and additional cash contributions. What next? Find a deal you're interested in. Find a deal you've read about and use press releases, company filings to construct your own sources and uses schedule. Maybe you won't be able to do it exactly, but you can come up with a rough estimate of it. And then be prepared for these questions in interviews. They're very common in private equity interviews, but sometimes even in investment bank interviews, you're going to have to know about it. And of course, if you get a case study on this, you get a modeling test, you're definitely going to have to know it for these interviews. And then finally, if you read about shareholders or activists, investors getting angry, like the Carl Icahn example, you'll know exactly why. So that's it for our tutorial on sources and uses. Hope you got a lot out of this one and that you understand the concept more effectively now.